freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here with Adam Penn. And Adam, I have a question for you.
Do you?
Yes, I do. Can you lift both of your eyebrows like one? Yeah, not like that, but like, can you do? Okay, no, you can't.
No.
All right, that's sort of the hard hitting.
Oh, you can't if you close one eye.
There you go. That's good. That's good. If you're listening audio only, you need to make sure to go back and catch the YouTube version of this to see Adam trying to raise.
I hope the editor doesn't like zoom in on my face there.
We'll make a note to do that. How you doing today?
I'm doing great. Enjoying it's the fog has finally lifted in Northern California and it has been replaced with rain clouds.
But it's just going to come right back, right? Like the fog in Northern California in wintertime is just like a fact of life, right?
It's year by year. It was like this a lot when I was a kid, and it hasn't been for a little while. I think if the wind stays constant, because it's just tule fog off the ground, it's radiation fog. So if the wind blows, it dissipates. But we've had zero wind, like literally 0 miles an hour, and just fog for like 25 days or something. And you climb up to, there's foothills around here. You go up to 1,500 feet or something, 10 miles up the road. It's bright blue sunny days, and you just look back and there's just a layer of clouds all across the valley.
That's crazy. And very annoying if you're trying to fly general aviation aircraft.
VFR, yeah. But fine if you're IFR, because but also some of the approaches coming in are minimums on not bad weather, right?
That's crazy.
We've had quarter mile visibility at like 4 p.m., 300-foot ceilings.
I don't know. We don't have that sort of stuff around here. We never get fog that bad. We'll get wind that will blow from all four directions, like 360 degrees all the time. So you kind of look at like what the wind forecast might be. This is especially, important for aviation. And on final, especially runway 23 at the airport out here, you'll have crosswind both directions. You'll have a headwind for a little bit. At some point, you'll have a tailwind. Like you're just going to get all of them on one approach. It's great. It's great for trying to learn to fly, let me tell you.
Oh, that's fun.
Well, I think we got something fun to talk about today. This is a No Investor Left Behind episode off of, I actually think the idea for this came up while we were recording another episode, and you sort of threw it out, and I thought it would make for a good topic. But the STR loophole, the short-term rental loophole, which I know you and I both kind of hate that word, but because it's really just following the tax code.
Yeah, it's not really a loophole, but it's a way for a lot of W-2 employees. We're not CPAs, not tax advice, but a lot of W-2 employees take advantage of this, and I did early on, to offset W-2 income through owning and operating a short-term rental. And essentially, we've talked a lot about depreciation, and we've talked about how, if you go buy a apartment building, maybe you can get 50, 75, 90% of what you invest in year one on the down payment as a deduction against income, and whether or not that's active or passive. If it's passive income, it can't offset your earned income, which is your W-2, because passive doesn't offset active income. And so you're always looking for a way to make that change, right? And really hard for a passive investor in a apartment building to say that they have any type of active income on that. But a short-term rental, all of a sudden you can be still full-time employed and be able to offset, claim material participation, which is what they're looking for. That's my understanding of the tax code. My CPA kind of double checks all of this for me, but the gist is that you materially participate on an active business. So it's no longer a Schedule E rental activity, it's a Schedule C business income. And the asset is the real estate. That's the part of the business. So it's treated as like a hotel. So now instead of a 27.5-year schedule, you're on a 35-year schedule, something like that. The regular schedule changes for the life of the equipment, and then you can do a cost segregation and bonus depreciate the 5 and 15-year schedules. I think it's 39. Where does the government come up with these numbers?
Random years.
Yeah. And so the idea is that, a good example would be a $500,000 house. You're going to be able to operate as a short-term rental. You're going to put 20,000 down. Maybe you put 10, maybe you're going to put 20% down. Maybe you're going to put 10% down. 10% is kind of a good example because you can do that on a secondary home or a primary residence. And so let's say you're going to buy this house and it's 10% down. So you put 50 grand into the deal and you're able to get 30% of it year one as a depreciable asset via bonus depreciation on 5-year and 15-year property. And we did a no investor left behind on depreciation. So if we've lost you already, go listen to that one. But if you get 30%, well, that's 30 times 500, it's $150,000 deduction. So you spent 50 grand and you got $150,000 deduction. Let's say you made $200,000 a year and you're at let's say $300,000 a year and your upper income is being taxed at 30% federal tax bracket. Now, all of a sudden, that 30% or that $150,000 might save you might save 30% of that, which is 45 grand. Well, 45
Direct
grand.
tax savings.
Tax savings.
Yeah.
Well, you only spent 50 on the building. So you've essentially got the building for free. And now it's, assuming you purchased it, right, there should be cash flow in it. So you're going to have this asset that can go cash flow. And I mean, as long as it pays the mortgage and makes normally like $500 a month, seems like a pretty good baseline. If it's, averaged across the year, I have a lot of short-term rentals and, without pulling up a spreadsheet and looking at it, we have ones that lose $2,000 in some months and make $10,000 in other months, right? So it's cyclical. It's not like a long-term lease. I have a fourplex that makes about $790 every month. It's about the same every month. If there's a maintenance call out, maybe it's $690, but it really doesn't change. Whereas our short-term rentals, there could be fully booked or no bookings. Then you need to do the material participation in it, which is 100 hours and no one can do more than you. Once again, this could change, but that's my understanding of the short-term rental material participation requirement to be able to call it an active business. So now if you go find the property, buy the property, set up the furniture, message some guests, maybe clean it once or twice, train some cleaners. Let's just say you put 150 hours into all of that. Now you have material participation. And as long as no one else has done more than that, so no one's done 150 hours, 151 hours, that's fine. Even if you have a cleaner who's worked 149 hours that year, it's still fine. You just have to do more than anyone else. So if you have a cleaner at 149 hours, maybe I suggest you have 2 cleaners, each doing 75 hours, just to keep it really safe. And by doing that, you're able to get the deduction. So now you're able to buy this house, essentially free. Once again, we kind of went through that scenario where you save the tax, pays for the down payment. And that was a high income earner, but the example works on lower incomes too. And you're going to be able to operate it. Maybe you can stay there a week or 2 out of the year, whatever you want to do. And Airbnbs are fairly time demanding. They're going to need some work. But another part of this that people don't, I think, talk about all that much is doing this towards the end of the year, call it September through December. And then come January, handing it off to a full-time manager. Our government has designed the tax system in such a beautiful way in their genius that the tax years reset on January 1st for some god unknown reason. And you have losses, those carry forward year over year because they're not going to pay you back for those, but your gains they're end dated. And so, you take that loss this year and then next year you don't need to I can't say materially
participate.
Thank you. We don't have to materially participate anymore in them. And so you could get a full-time manager, right? I own a short-term rental management company. I don't want to call it a side business, but it's a business that I've built that I no longer have to day-to-day operate. And it manages my short-term rentals. It manages a lot of other short-term rentals. And so you can find someone like me, reach out to me or anyone else and have them operate that short-term rental in the second year, which leads to the ability to then be a little more hands-off. And this is something maybe a little more specific, but then if you want to buy another one the next year, my understanding from my conversations with CPAs is that you just have separate Schedule C. So compared to lumping all that business activity into one Schedule C, now all of a sudden the one you bought in 2024 is one Schedule C activity, and you create a new Schedule C activity for 2025, and you make sure you get 100 hours and all the same requirements and all that, and then you hand it off to a manager the next year, and then rinse and repeat. And I believe that is totally legal. They're different activities.
And that's the loophole. That's what people call the loophole, is being able to kind of do that in 1 year and then rinse and repeat and continue doing it. I have several thoughts on this. I think
That's a first.
what's that? It's a first.
You having thoughts?
Yeah, I know, right? I hate that this has gotten labeled as a loophole because it really is just following the rules. This is what's been set out. We can argue the sanity of that, whether or not it makes sense, for the tax year to just completely reset at
or
midnight.
For there to be taxes.
Yeah, exactly. I know your opinion there, but this is kind of the way that I think, especially coming out of COVID, there were a lot of hiring W-2s who were doing this, and nothing wrong with it. I think there are a lot of people who would go in and say, well, yes, we'll do this. Airbnb's fun, and it is fun when the market is ripping and roaring, and the market for Airbnbs, particularly on the demand side of it, is high. But Adam, to your point, it's very cyclical, and the market's definitely not what it was 4 years ago in terms of demand. And running an Airbnb,
expenses are higher too.
Right.
Demand's down, expenses are higher.
Yeah. And it's a lot of work. I mean, it's not like, there is a little bit of a reason why this gets considered as an active loss, right? Like you talk about materially participating. There's a decent amount. And yes, you can hire some of that out, and if you want to bring on a cleaner, but the whole act of ensuring that the listing's up to date, responding to guests, responding to inquiries from potential guests, all of that, it's a very active business. And so it's something that, like, if I've encouraged several people before who brought this as like, oh, we're thinking about doing this, like, nothing wrong with it. But for one, make sure you're taking a realistic view of what from a cash flow standpoint. Let's forget the tax side of this. Like, is this going to be a good investment or not? Because you really don't want to do this solely for the tax benefit. I think if you're looking just for the tax benefit, there's a lot better ways to get it than to potentially pour a lot of capital and a lot of time into something that you might lose the capital and you're never getting the time back. So don't simply do this for the tax benefit. But if it makes sense and it's something that you want to do, just go into it eyes wide open and know that, okay, we're underwriting this correctly. We're not taking an overly optimistic view on the short-term rental market. Like, we're buying at a good price. This is going to make sense. It's going to cash flow. Sorry, do you have?
No.
Okay.
No. I mean, well, maybe a comment I was going to say was that I've used, I've even looked at, I haven't bought a lot of STRs recently, but I've looked at buying a cabin up in Tahoe, and makes a lot of sense there. I looked at it from a tax purpose at the end of this year.
Maybe it does make sense. Again, I say don't buy it just for the tax. I think the bigger comment there is, again, going into it eyes wide open and know, okay, maybe you are trying to get some sort of tax benefit, and you know that the cash flow on it's not going to be great, and you're comfortable with that, and that's maybe you want to own a cabin in Tahoe as a lifestyle decision, and you're okay to lose a little bit of money on it and get the tax benefit right now and maybe have it. But again, don't go into it assuming, listening to a lot of the STR gurus, that it's going to be, anything you buy is just going to gush cash flow, because that's far from a guarantee, and it's most likely going to be more work than you're anticipating. But this could be a very, again, if you got the property, it makes sense, it's in a good market, you're going to be able to buy it at the right price. This could be a very useful tax planning tool. And the benefit, right, wrong, or indifferent to the tax year, resetting it December 31st, is that you can buy it and then turn right around the next year and just do it over again and stack these things. And again, if you buy them, it's going to produce cash flow. It's going to pay for itself. It's a decent way to acquire a little portfolio of income producing properties and help build some.
And they're single families normally, which appreciate pretty well.
Yeah.
Right. And so it can be good to 1031 into a bigger deal.
Yeah. So that, grow a portfolio and exit that at some point in the future. And, the exit doesn't always have to be to someone that's also going to run it as a short-term rental. It could just be to someone that's going to buy it because it's a single family house in a good location. So there's a lot of pros to this loophole, we'll say in finger quotes. But at the same time, I think a lot of people get caught up in for one, the tax benefit, and two, the idea of short-term rentals just being a cash flow machine. And it's just important to know that that's not always what it's cracked up to be. And before you go down this path, ensure that ensure you understand what you're getting into. Because again, if you're purely looking for the tax benefit, something like the oil deal we had at the end of 2025, if that's all you're looking for, that's probably the better option, because the oil deal is not going to have tenants calling and potential guests asking questions. What's that?
It doesn't have debt.
It doesn't. Exactly. And that might be a pro, that might be a con.
Well, I think it's a pro, right? You might not get a leverage deduction, but you're not worried about debt servicing.
Right. Right. Yeah, you're not. There's no ongoing. It doesn't have an ongoing expense, whether that's debt or just the operating cost of the property and property taxes and things like that. So that's why I say if
We
all
should-
you care. Go
We
ahead.
should rename. We should, the way we say property tax. We should call that the government rent.
Government rent. Yeah.
Here on out.
But no, I think we kind of covered this one. If anyone has any questions, we're obviously happy to answer. Adam's definitely got more experience on the short-term rental side than I do, and if you ever have questions about operating a short-term rental, or like you said, if you're interested, if you've got a short-term rental, and Adam, I'll shield Penn Properties here for you. If you've got a short-term rental and you're tired of running it yourself, looking for a third-party property manager, Adam would be a good one for you. Reach out, pennproperties.us, or I don't know, shoot us an email, short-term STR at wealthindependencepod.com. We'll get you some information back on that. I don't know. Any final thoughts or comments? Anything left to add here, Adam?
I don't think so.
Sounds good. Well, we will get out of here for this one. Everybody, we appreciate you listening. Again, if you got questions, got feedback, reach out on the website, wealthindependencepod.com. We got a contact form there. And do all the things to let the computers know you're enjoying this. Give us a positive review on Apple Podcasts, whatever you do on Spotify. Like and subscribe on YouTube, all the fun things. Help get the message out to more people. We would certainly appreciate that. But we will catch you on the next episode. Thanks again for listening. And just remember, where freedom leads, real wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice, and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.